Hey, welcome back to another episode of LEPH Free Training. Today we will be going over, the first thing we'll be going over is support and resistance. I know in the earlier class, we did talk a little bit about support and resistance, but on this class, we will talk a little bit more on support and resistance, and we'll see how I draw my support and resistance. So you guys also go do the same. So I told you guys last time, and for those that were not there, I told you guys support and resistance is basically price potential reversal areas in the market. I always like using the word potential because it doesn't necessarily mean that price might have a reversal at that level, but it might depend. It might have a major or minor impact to the move, just depending on whatever time frame it is or whatever is happening. So like say, and support and resistance is literally on every single time frame. You can start drawing the support and resistance from the 1 minute time frame to the 1 month time frame, but you need to look for the major areas where price has the main moves from. You don't just randomly draw it all over your chart. Now you gotta look for the main levels. So for support and resistance, right? Resistance is known as a roof and support is known as a floor. Hope you guys have your notebooks out. Resistance is the roof, while support is the floor. So in the case where price is moving and approaching a resistance, price is like, it could most likely reject, that is, it bounces up that resistance. It's like you're moving, like I said, it's like a roof. It's like you're moving upstairs, right? It's like you're living in a 2-floor house. And if you move upstairs in that 2-floor house, you definitely, if you hit the roof, you're gonna bounce back. So you can either hit the roof and bounce back and go back down, or you have to break that roof, or basically if you have like a pathway to move towards, you move. And then now what happens if you break out from that roof? What happens? Who can remember from last class? When you break out of the roof, from out of resistance, when price break out of resistance, what happens? Nobody knows? All right. It's not becoming support. That is correct. Resistance becomes the support, like it breaks and retests, and resistance becomes support. So there are two scenarios when price approaches your resistance. It could either reject, or it could do a continuation, which will happen as a break and retest. So now you need to, now as traders, with time goes on, you need to be able to identify that, okay, when is the situation that the price will reject and when is the situation that the price will reverse. Rejection is basically meaning it bounces off. It bounces off and goes down. That is rejection. It bounces off. Continuation is it has a break and retest that turns the resistance now to support. So it's like you go upstairs, this floor that was above your head becomes the roof that was above your head becomes the floor. Simple. And vice versa to the knowledge of support. If price is approaching support, right? It could reject off support. That is, it bounce off support, or it could approach support, break support, and then what will support turn into? Who can tell me in the chart what will support turn into? Yeah, resistance. So support tends to resistance at this point when price breaks and it starts going down. So now you guys have that idea to know that, okay, so support is able to turn to resistance and resistance is able to turn to support, right? And in the scenarios where you need to know that there's two scenarios when price approaches your support, it can either break and retest when it approaches support or resistance. It can break and retest, or it can go ahead and just only, it can break and retest, or it can have a rejection. So those are the two scenarios. So that being said, on that situation, when looking for support and resistance in the market, I personally, for one, there are three scenarios that you'll probably see. There are three scenarios that you probably see, right? So one of the scenarios are, like I said, support and resistance are potential price reversal areas. So one of the scenarios that you might get to see is this scenario that I call the touch. You want to see price using a certain level as a support and a resistance. Those are the best type of support and resistance lines. You don't want to lose. You don't want to see a place in price where price uses a certain level only as resistance or only as support. So this is one scenario which I will call the touch. That one is called a touch. And there is another scenario where you're looking at price, and we will call that the gap, where price doesn't really touch, you know, it doesn't really touch the support or resistance line. It's just literally like, it's like close to it, but not too close to it. Why did I say like that? Because, you know, these things, you're the person that is drawing this. It's not like something that the market has drawn, but it's what you are drawing. So you can't really have exact precision sometimes. It's just like, it might just be in between. So it's all right of being almost there. So you just got to understand that you have the gap. And if price is playing in between that gap, it's still very much a support or resistance line. And another thing that you have is, the next one you have is the overlap, where you see where price kind of like go a little bit underneath and comes back and does that. All of this, when I show you guys on the chart, will make more sense. So these are the three scenarios probably you will see. This thing doesn't want to cancel. You will see when we join our support and resistance lines. So this is called the overlap. So that's the overlap. This is a touch, gap, and overlap. When drawing your support and resistance lines, you will see. Ignore the way this drawing came out. That thing wasn't trying to like stop chasing. So let's go on the chart, right, and see what we can come up with. Oh, turn off my moving averages so I don't get confused. So me per se, I like starting my support and resistance lines on the daily time frame, and mine are color coded so I can know which support and which resistance, which time frame has my support and which time frame has my resistance. So take this down. The higher the time frame, the stronger the support and the resistance. The lower the time frame, the weaker the support and the resistance. So if the price is reacting off a daily support or a monthly support, I know that, okay, that level is a really, really strong level because it took a whole month to react off that level. But when it's like a whole 1 minute, 1 minute will just like, you know, will break. Like I said, with trading, everything is the same throughout every time frame. It's just the ones on the lower time frame happen way faster than the one on the higher time frame. So as time goes on, you become more comfortable with like things like time frame correlations and, you know, being fast at executing trades, then why not? So we will go, and another thing with me, I draw my support and resistance lines using the line chart. I don't just draw it using the candlesticks. So this is where we use the line chart. So like I said before, the scenarios is we're looking for the gaps, the overlays, all that type of stuff. So right here, we can draw price on my daily. I use the black lines instead. So the reason why we're drawing these support this support line here is because right here price acted as resistance, and here price is kind of about to act as support. So that's why we're drawing it. So you want to draw on places where price is acting both as support and resistance. You look again for another potential reversal area. Right here will be the example of the gap. This would be the gap because right here price acted, even though it didn't push all the way down, but it did like react off this level. You guys can't see it now, but with time you'll be able to understand all this. It acted right here as resistance, acted right here as support, acted right here as support as well. And looking again, like you only draw what you see. Give me 1 second, guys. That's forever to go through. All right, so we're looking again for another potential reversal area. So right now in this scenario, this could literally be like the upper layer, where the overlap, where you can see that price overlapped. You overlapped here, and it kind of like overlapped here and overlapped here as well. So we still like price acted here as resistance and acted here as support, resistance, all this one. So there's like a gap as well. So you cannot be moving in this thing and trying to look for the perfect like touches on price. You're just literally looking at the most accurate that you can get. You're not looking at like the entire perfection, because you cannot really all price will never react the same throughout every time frame, or throughout from the past reaction to the current reaction. It will not be at the same price level. It might be a couple of pips away, or or before. So that's just something you guys need to know. We draw it again here. Price acted here as support, acted here as resistance. So that is like, we've drawn that now currently. I could just do this one. Yeah, I could literally do this as a gap. So we'll just draw out of that, and now we'll go on the lower time frame again. We'll go on the lower time frame, and majority of the time when you're drawing support and resistance, it's good to always just draw where price is currently at. Not like, you don't need to draw your support and resistance all over the chart, like all these places where price has not even come to. You need to draw your support and resistance where price is playing around, like the areas price is there. Like, doesn't make no sense you're fighting the battle when price has not yet come there. So you go on the 4-hour time frame and you do the same thing, rinse and repeat. You look for the same areas and you change. I personally change the color as well. So I put like probably like red or something. So we can see that, okay, price here, this is a strong level, price reacted here, again. Even like right here was a gap, all these places, all of that was like a nice level of support and resistance. You could look again for another level, price level. Like right here, that's another good price level. You can, in between every daily support and resistance line, you could probably draw like 2 or 3. You could probably draw like 2 or 3 support and you could draw 2 or 3 4-hour support and resistance. Like you can see that now clearly we want to draw a support and resistance at this level, but we can't because we currently on this screen we can't see no data. So you have to like scroll and stuff, move to the left and look at past data so you can go ahead and draw. Like all these things. Let me see, this was right here, that. So you just scroll left and look for that past data, and then you draw what you got to draw. But if you don't see it, you don't draw, you don't force it. You draw what you see. On the 4-hour, we can't see anything right now. Zoom out again. Yeah, we can't see anything much on that price level. Everything is currently above it, so there's no problem. You just let that be, like right there. The only one you have currently will be this one. which is here, where price rejected off this little rejection, and then this was a break, this was a rejection. So that's what you have right there, and you use that. And when you jump on the 1 hour time frame, I go back now to my candlesticks. I don't longer use my what my line chart. I use the candlesticks now. So that is that on support and resistance, how you do it from the daily time frame to 4 hour time frame, then to the hourly time frame. That's how I personally do it. Then when you have like, I also use random support and resistance where I see like areas where price has potential reversals and I haven't actually marked that up. I have I could use like a random ray and be like, okay, this area, let's say like this area, I could draw like this area right here is a random support and resistance, because right here price acts as a support and price broke and act as a resistance. So this is a random area of support and resistance. But I feel like that comes with time, like that comes with experience when you need to know how to use random support and resistance. But know that you will not be able to mark up every single support and resistance, because you don't want to make your chart so clogged up. You just want to mark up the major support and resistance. And the next thing I'll tell you guys is also called minor resistance and major resistance. Major resistance takes time to form, while minor resistance takes lesser time to form. So you can literally draw a major resistance zone or area like here. Like you can draw this and be like, this is a minor area right here. Like price has played around this level and it created the level of support. That's a minor area. The same thing right here. Price created a minor area right here. Like today when I was trading gold. Gold gave me a minor area on the 1 minute time frame. Where is that minor area? Yeah, this is the minor area of support. So I drew this minor area, and when price broke out of that minor area, you see what happened. So you can draw like, okay, this, I didn't draw a support or resistance here. I just like, okay, this is a minor area. Wherever price react off from is creating a minor or major area, just depending on how long it takes for price to react off that level. Did that make sense to you guys? If it makes sense, you drop a 1. If it didn't make sense, you go ahead and ask the question that you have towards it. All right. A lot of people are dropping ones. Because I've so far I've shown you guys the different scenarios. You will see the support and resistance, how to draw them on different time frames, the major and minor areas of support and resistance as well. So okay, so we got that out of the way. That is pretty nothing too difficult. You just need to keep practicing on how to draw them. Like I said, don't clutter your charts with it. Draw what you see, you don't force it. You don't force what you don't see. So now we're going to study one of the major things of trading, which is structure. Like if you don't, no matter the strategy you trade, you need to know structure. You need to know structure. You need to know where you're at in the market. You need to know whatever phase you're in the market. So first thing first, I had told you guys, I think on like the very first ever day one trading, that the market moves in 3 ways. The market moves in an uptrend, which is called a bullish market. It could be called a rally. The market is in a rally. Then the market moves. The second way is in a bearish market, where it's it's a drop market, seller's market, or the market moves sideways, which is called consolidation. So number one, uptrend, which is the bullish market. And this moves with higher highs and higher lows. It moves like it's like in staircases. The market doesn't just shoot up like a rocket. No, it moves like in staircases, slowly, higher highs and higher lows. So this happens because it's like one of them is dominating at that point, and the other is like, okay, giving a discount. Like you say, when the buyer's market is an uptrend, the market buys up, then it sells a little bit, giving a little bit discount to the sellers, and buys up again even more, give a little bit more discount to the sellers, and buy again more. When I'm talking about discount, you guys will start when we start using something like the FEEP to measure those discounts, you get to understand better. So price does that again, just like that. And all of this movement is called higher highs and higher lows. These, I hope I have those templates. Yep. This is a higher high, and this is a higher low. No matter the strategy you trade, you want to know this thing, because as far as you don't know this thing, you'll always be on the wrong end of you always be on the wrong end of trading, always be on the wrong end of the market. All of these are called higher lows. They are called higher lows because they are higher than the previous low. That's when it's called a higher low. If this low is lower than this previous low, it cannot be considered a higher low. So just by the name higher low, it means it's higher than the previous low. And as a higher high, it means the current high is higher than the previous high. Does that make sense? Did that part of structure make sense to you guys? Yeah, if it made sense, you drop a 1 in the chart. Like, you know, by now you guys should know we dropping 1s. Can you explain that again from the higher low? All right. Like I said, the market moves. One of the scenarios, the way the market moves is in an uptrend. This, it creates higher highs and higher lows. Higher highs and higher lows. Higher highs, higher lows, higher high, higher lows. Just like that. Just like this is the simplest way and the best way to trade. You want to always be on when you want to always be with the trend. So when the market creates a higher high, it definitely has to create a higher low. The market creates again another higher low. What you're expecting after a higher low is a higher high. After another higher low, after another higher high is a higher low. This is only called a higher low because it's higher than the previous low. If this low is lower than this previous low, it is not considered a higher low. And if this low, and if this high is lower than this previous high, it is not considered a higher high. Does that make sense? If it makes sense now to you, you let me know, please. All right, cool. So now we go on the other scenario where it says the downtrend. So in this scenario, the downtrend will create what is called lower lows, lower high, lower low, lower high, lower low, lower high, lower low, lower high, and then lower low again. That's a lower high, and that's a lower low right there. lower low, lower low, lower low, and lower low, lower high, lower high, and lower high. So when you're looking at the market on a seller's market, it forms things like this. It forms things like this on the downtrend, and this happens on every single time frame. Like I repeat, every time anything that happens in trading, no matter what time frame is, the 1 minute, it happens throughout every single time frame. It just takes longer on higher time frames, point blank. So if you have these lower low, the next thing you expect is a lower high, and you have a lower high, the next thing to expect is a lower low. You have a lower high, the next thing to expect is you have a lower low, the next thing to expect is a lower high, just like that, vice versa. So the other scenario the market moves is the consolidation market, which is sideways, which it gives equal highs and equal lows. And this is where we will see one of our market chart patterns that we taught on the last class, which is the parallel channel. This is where you see, and this is where you see it looking like. It looks like something like this. This we taught on the last class. Parallel channel, it gives equal highs and equal lows. So this is one of the type of market where I personally advise people not to trade. You can only trade such a market when it has a high peak range, like it has a high peak range in between. Let's say something like this on the 5 minutes, and in fact, let me just say on an hourly time frame, it's not good to trade, but like you could trade it on the 4-hour time frame, because when it comes to like resistance you sell, it comes to support you buy, resistance you sell, support you buy, to the day like it finally breaks out. You could play rigs like that. But when it's like on the hourly time frame and lower, don't trade consolidations. But on 4-hour and higher, you can definitely trade consolidations, because it has a higher peak gap. There's certain consolidations in the market that has probably like a whole 300 pip gap from the support to the next resistance. You can do it, definitely trade that. But when you trade something like this on like the hourly that has only like a 36 pip gap, like that doesn't make no sense to trade. You avoid such markets. So we have learned that. Now let's learn how to validate an uptrend. No matter how our uptrend is moving, how to validate an uptrend. So the way, so before I move forward, so far, everything I said, have you guys understood that? Everything I said so far, does it make sense to you guys? My keyboard is slow because I'm typing faster than it's showing me my letters. To charge this thing. What part of it should I explain again? My keyboard is slow. I was just saying that, on an uptrend, when you see a higher low, the next thing to expect is a higher high. Again, if a higher low forms, the next thing to expect is if a higher low forms, the next thing to expect is a higher high. And for the downtrend, if you see a lower high, the next thing to expect is a lower low. And if you see a lower high, so again, it's lower low. If you see a lower high, it's a lower high. I mean, if you see a lower low, it's a lower high. If it's a lower high, it's a lower low. And that is how the market moves. It moves in staircases. So in this type of market, predominantly, the sellers are dominating, but are still giving the buyers a little bit of discount in every price. How price is still moving down. The price is moving down mainly, but it's giving discounts as it's moving down. And in an uptrend, when it's moving up, it's giving discount as it's moving up. And the other way the market moves, which is called consolidation, which is in a range, the market will literally be consolidating, right? It literally consolidates. That's the range. And I said that the best way to trade these things is from 4-hour higher. If the market is in a range, on an hourly range, do not trade it, because it definitely has less pip count. But if it's like on a 4-hour range, go upwards, then you can go ahead and trade that. I personally don't see nothing wrong with that, because it's literally playing around a resistance and a support. So when it gets a resistance, you sell. It gets a support, you buy, depending on what price action it gives you around that area. Did that make sense to you now, Noel? All right, cool. So now I want to teach you guys how to validate structure. Where market moves in an uptrend, like I said, it gives a high, then it gives a low, a higher low. It gives another higher high, then it gives a higher low. It gives a higher high, it gives a higher low. So in the case where the market might do all this type of movement, it gives like, instead of giving another higher high, it is giving a miniature lower highs instead. But so long as the market doesn't clap the major higher low, this structure is still valid, that is in an uptrend. But the moment price goes below the previous higher low, that market structure has switched or is about to be switched. It's not yet fully concluded, but it's still about to be switched to, from an uptrend to a downtrend. So the notes you're taking down here when it comes to validating an uptrend is making sure that price still maintains the previous higher low. The higher high could not be maintained. The higher high could tend to lower highs, but so long as the previous higher low is still maintained, price is in an uptrend. Did that make sense to you guys? You validate an uptrend with the lows, with the higher lows. As long as the higher low is not clapped. All right, I think I should explain break of structure first before explaining confirmation of structure. All right, let me explain this to you. I'm seeing how they made it responding, but I'm gonna just go ahead. So let me explain this scenario to you guys, which is called a break of structure. How market transitions, and you guys now will start seeing things like the patterns we were talking about earlier in the second class. So you realize that, oh, those patterns are not really necessary to see them as a double top or see them as a head and shoulder. You could just see them as a reversal happening in the shift of structure. Because now your brain is getting more developed with time. So certain basic languages are no more used, and more advanced languages and thinking is being used into everything. So let's say in a scenario where market is in an uptrend, creating a high, creating a higher low, creating another higher high, another higher low, a higher high, a higher low. Then it's supposed to give you, then it gives you another higher high, right? And the market, after a higher high, what do you expect? After a higher high is formed, what is the next thing that's supposed to be formed? I want an answer in the chart. A higher low, right? So now, but the market goes lower than the previous higher low and gives you a lower low instead. Instead of the market, you expect that, okay, the market will give you a higher low, but instead came and gave you a lower low instead. Why is it called a lower low? Because it is lower than this previous low. So in turn, meaning that market is about to switch structure. I haven't said the market will switch structure entirely, because sometimes the market might come all the way down like this and just sweep out people's stop losses and then starts buying back up. So the only way for you to confirm a full break of structure is when the market creates a gain after a lower low. What is the next thing we're expecting to see? After a lower low is formed, what's the next thing we're expecting to see? A lower high. That is correct, guys. Beautiful. A lower high. So now when you see that lower high forming, what is the next thing you're expecting after a lower high again? A lower low. Beautiful. So the market gives us now a lower low. So this market has in turn switched from an uptrend to a downtrend. So the market moves again and pullbacks and gives us it gives us the lower low and gives us another lower high. Then we're expecting again another lower low. And then you're expecting after this lower low again, what is the next thing you're expecting? the market creates us a lower low, a lower high. That's the next thing you're expecting. But when the market pushes up, it pushes up, right, above this previous high and gives us what? It gives us instead a higher high, because this high is higher than this previous high. So now we are about to switch structure again from a seller market to a buyer's market. So now, after we have this higher high, what is the next thing we're expecting to give us? We have a higher high now. So what is the next thing we're expecting market to give to us? A higher low. Okay, in this case, let's say the market gave us that higher low. Then the next thing we're expecting again is a higher high. So that is how market structure is being switched. So right here, market structure changed. And right here, market structure changed as well. And these places, we call them BOS, the break of structure. The break of structure happened there. And the break of structure happened right there. So with trading, you need to always know what is coming after everything. But you have to wait for it to fully validate itself before you're entering, because you might see, like I said right here, the market might give you this lower low after breaking this higher low, right? Let's go ahead and label this so we we're seeing everything as I'm talking. It's making sense. It's not like I just, as a higher low. I like the communication in the chat, guys. You guys are picking it up. That's very good. This thing, you need to know it the back of your hands, because no matter the strategy that you will learn, you will need this. Because if you're on the wrong side of the market, trust me, you won't make no money. No matter what you know, no matter the price action you know, no matter the liquidity sweep you know, or whatever you know, as long as you're on the wrong side of structure always, the moves will mostly never be long-term. It will always be short-term. Like you get in the trade, you see you've been in the trade like a couple of minutes, then the next minute you're realizing that, oh, you're in drawdown, or you've lost that trade because you're there choosing the wrong things. You're holding the wrong trades. So this is a higher low. And when price went below our higher low, it gave us a lower low instead, breaking that previous higher low. So they gave us now a lower low. So now we're expecting a lower high. Where's that texting? A lower high right there. Lower high. Lower low. Lower low. Higher high. Higher high. Higher low. Higher low. All right, so this is where the confirmation of structure happened. The confirmation of the break of structure happened when market went lower than this previous low, and then came again and gave us a lower high and started selling. That is when the confirmation happened. Right here, this confirmation, that's where it happened. The confirmation did not happen down here. This movement down here induced the move. It started the move, but it didn't confirm that the move will actually happen. Like I said, in the market, in the Forex market, there are times that you realize that, okay, these people are smart people. They know people have their stop losses below this low. So the market will literally come and sweep people's stop losses and take their money. And they call that liquidity sweep. It takes that and then it goes. It could be yeah, basically you could just call liquidity sweep. I don't want to complicate it right now for you guys. I just say that it takes those stop losses. Or what's the better term to use, Victor? Should I use stop hunts? I could use stop hunts, but the term doesn't matter at the end of the day. Is the idea, the ideology that you know that this is happening, that really matters. So I would say, okay, they come down, they take our stop losses, and then they push back up, and then it starts creating a higher high instead of a lower high. So being that you thinking that, oh, the market has just broken down structure, and then you're getting for a sell at this point, and even if you put your stop loss above this high, the market might still buy up and clap. Because remember, when you're in the buyer's market, this is, let's not even go into that. I'm not even going into that because that's entries and exits. That's a whole other topic. But let's just stick on this first for today. Like that, you have to wait for the lower high to be formed to confirm that break of structure. The same thing on this other side. When the market came here and this, you're expecting that, okay, the market gave you a lower low. So the next you're expecting is a lower high. But in turn, it gives you a higher high because this high is higher than the last higher, the last high that was created. All right, it gives you a higher high. So that's like, okay, it's inducing the break of structures. It's inducing the switch of market direction, right? But it's not confirming the switch of market direction. The confirmation of the switch of market direction is when it gives you that higher low. When it gives you that higher low, then you know, okay, the next thing again is another higher high. So on this part, you'll increase your probability to having a buy trade, a better chance of having a buy trade by like 70%, compared to if you have taken a buy trade from here, your chances would have been at probably like a 30%. So you taking that buy from here is better than taking the buy from here. So another thing that you guys could see, if you can see that, is what we talked about in our second class, the reversal patterns, which is basically, this is like a head and shoulders. This looks like a head and shoulders right here, right? Could any of you guys see that? It looks like a head and shoulder. Then the break of the neckline, the retest, and then it sells. You guys can see that. For those, you see that, right? And this one right here looks like a double bottom, and then it breaks and then it goes up. So all those reversal patterns are just a kind of like a simpler way of seeing a switch of structure for people that are not really keen to knowing like things like that. It's like a way of seeing a switch of structure. So that is that. So now we've seen how break of structure works. Did everyone understand break of structure so far before I'm moving now to validating structure? I'm seeing another one person answering though. What happened to the other people on the call? I got the concept so far. All right, good. So now when we're validating structure, and we're talking about that same thing for an uptrend. So long as the market, a little bit for me, I'm sure I understand better. All right, great, no problem. So now we're looking at an uptrend, and we said that it's going to like increase higher highs and higher lows. So long as this is a previous low or high, and the market starts, instead of the market giving you higher highs, it instead gives you lower highs and gives you miniature lower lows. This is the major higher low. So long as price doesn't go below this major higher low, structure is still very much valid on an uptrend. That's what I was talking about earlier. So while structure is doing that, structure is literally forming one of our patterns called an ascending triangle. You guys remember this when we studied it on our reversal patterns? So at that point when structure is doing all these, you're seeing all these instead. So structure has not yet clapped. This is a major low. This is a major low right here, a major higher low. But structure is creating miniature lower highs and then creating miniature lower lows. But this is a major low. So this is another thing where we have major structure and minor structure at the same time when the market is moving. Like the market could literally make a move like this on the 4-hour time frame, it could literally make an uptrend like this, right? It shows like a clean uptrend on the 4 hour time frame. But when you come on the 1 hour, it's doing this on the 1 hour. It's doing all this movement on the 1 hour. It's moving like that. But on the 4 hour time frame, this is what you're seeing. But on the 1 hour time frame, all of this is happening. Because this is minor structure moving towards the direction of major structure. Right here, we're validating this structure. So long as price doesn't go below this, we're still very much bullish. And that's where you see our reversal pattern that could be formed and it breaks above and then it gives you that buy and it goes above the previous high and so we're still validating structure. And vice versa for the sell. Since for the buys, we validate structure by the lows. For the sells, we validate structure by the highs. So long as that high has not been broken, right? Like structure is still very much on a downtrend. So long as that this high has not been broken, structure is still very much on a downtrend. The previous high has not been broken. No matter how a consolidation could happen or whatever could happen, or some structure right here could be broken back and forth, you need to be able to identify the major structure, which was this high or was this low. So when I said broken, it means for structure to be switched to the other direction. Like, okay, now we're selling, it will structure switch to a buy market or to a sell market. You know what I'm saying? Does that make sense to you guys? Good. All right, cool. I'm glad you're picking it up because this thing, you have to practice it and know it to the best of your abilities because trust me, when it comes to your risk management, you need to know it based on structure. You know that, like me personally, when I'm trading a retracement market, right? A retracement market, a risk is usually less than what a risk doing an expansion market. But now we come into that, what is an expansion market and what is a retracement market. Let's go ahead to identify those things. Hope you guys are taking screenshots, you're drawing these same things, you're writing notes because you will need this. You will need all these. I'm going through all these. There are even still some advanced traders that is like people that have been trading for a while and they still don't know none of these things. Because it's like just ignore certain information, which is crazy. All right. So we've learned that the market moves in 3 ways. Now let's learn the different phases of the market. We have number 1, we have the expansion phase. Because before trading, you need to know what phase you're in. Expansion phase. This video has so much knowledge. I feel pity people that are not on this call today because everything after this, they will not be understanding. We have the expansion phase. We have the retracement phase. We have the reversal phase of the market. The reversal phase, and then we have the consolidation phase of the market. All these phases, you need to know them. You need to know all these phases. And this is how we'll be able to identify these phases right now. I'll show you guys which is which, right? Because if you don't know these phases and if you don't know where you're at in structure, every knowledge after what you know is useless. That's why you're not winning trades. You have to be on the right side of everything. Like so far, I've had people that follow me on the gram and everything, and you guys pay attention. We've had a 20 win streak. Today we lost 1 trade after winning 20 trades in a row. It was not even a wrong trade. Like it was a wrong trade, but I was not wrong about the direction. It was just because of the fact that there was a news release at 10 o'clock and it just had a whole spike from nowhere. But the trade still went to our direction, though it really clapped us out. But I was like, it's whatever. It's cool. That's part of the game. That's why I need to pay attention to the news. I didn't expect such a news to have such an impact, but no problem. It canceled my 20 win streak. There's always next week to continue, and probably I might create another one. Like, that was me creating that win streak, was me knowing every single phase I was in the market, what side I was in structure, and waiting for my price action. These are the three major things on my foundation of trading. You guys will see that. Like, trading is not that difficult. You need to treat yourself like a freaking robot and just, practice so you can identify those things. So in our first, we'll look at this on a downtrend market and then on an uptrend market. This market, let's say it's on a downtrend, creating lower lows, lower highs. Why this thing stop? Lower low, lower high, lower low. All right, we're going to stop there for now. In this scenario, right, this push the market makes down is the major move. Every move the market makes down is the major move. This move that the market does is called their retracement move. So this, should I choose the bubble? Let me see, where's that bubble thing right there? Choose this. So this move right here, that is selling down, that's the expansion phase that the market is in. The market is in an expansion phase. This phase is called an expansion phase as it pushes down. This phase right here, this one, is called the retracement phase. This one here is called the retracement phase. So this is an expansion phase and a retracement phase in the market. And the turn again, the next one is also going to be an expansion, and the next one will be the retracement. So on the downtrend market, when the market is selling, the sells are the expansions, the buys are the retracements. So right here, we have the sells, which is a major move. This is the sells right here. I think I should use the call out stuff again. Where is that shit at? Are you guys seeing the amount of value that's been dropped in this video today? Like, that is the sells. Then the buys that happen. So the buys are the retracement, the expansions are the sells, right? And then when the market goes into a break of structure, and then it confirms the break of structure, what happens right here? Or in turn, even before that happens, what happens right here before it even starts is the market entered into a retracement phase. Then later on, you confirm the break of structure. So in this moment, the market is in a reversal phase. Reversal meaning it's about to switch up, it's about to change direction. Reversal, right? Reversal phase, basic English. Reversal phase right here, also known as BOS, break of structure. So the market breaks structure, it goes up. That is now the market is concluded break of structure, you buy. So the market goes now into equal highs and equal lows, equal highs and equal lows. And the thing with these phases is the phases don't have no particular order. The phases have no particular order. Anyone could come before anyone. Anyone could come before anyone. I mean, like for something in the case of an expansion and retracement phase, after an expansion phase, you always have to expect a retracement phase. But the thing is, after an expansion phase, you don't really like, you have the retracement phase, and the retracement phase could always turn to a reversal phase, because in this moment, this movement up here was a retracement happening, but it kept on retracing until it finally broke above the previous high, right? And then what happened? A retracement phase, then I turned to a reversal phase where market pulled back down and kept on buying. Does that make sense? How you saw, I was seeing how a retracement phase is always most likely to turn to a reversal phase. If that makes sense, you drop a 1 in the chart. Beautiful, beautiful. All right, so that happens like that, right, guys? Gives you that consolidation phase. So you have that consolidation phase. Now let's look at how things look like when the market is in an uptrend. Now in an uptrend market, the buys are the expansion while the sells are the retracement. The buys, the expansion, sells, the retracement. So now it's different. Don't come to a buyer's market and say, oh, the sells are the expansion, then the buys are the retracement. No, the buys are the expansion instead. Buys are expansions. While sells are retracement. Sells retracement. Buys expansion, sells retracement. That's how it goes. So this is the market phase, and any of this phase could come before any other. You just have to know which one is which. And in the seller's market, you want to always be doing the expansion phase. You don't want to be doing the retracement phase. You want to be at the start of the expansion phase, and the market will start expanding after the retracement phase is done. So you want to be entering a trade at this top right here, and then it retraces just like that. Then you break structure, all of that. When it breaks structure, that is when you have to get out of a trade, when the market breaks structure, because like it's showing you that the market is about to change direction. So why be in a trade? It's about to change direction. I'm just thinking about it actually. Any questions so far about everything we've explained? Is everything clear, guys? Is it please take the last step over? You mean like from the consolidation, or you mean this part, this sales retracement? Like I was just explaining that when it comes to a buyer's market, right? The retracement phase is the sales, while the buys that happen, the push up that happen, are the expansions. But here in the seller's market, we can see it's in a downtrend. You can see that, oh, when it's selling, right? When it's the seller's market, that's the expansion here, and when it's buying, that is a retracement. So I was just giving that difference out. That was the last part I was like, talking about. Just like consolidation phase. Consolidation phase, you always have to wait for the breakout. That's what you have to wait for. A breakout to happen, then you're in the consolidation phase. Is that it? Okay. So another thing when it comes to identifying the trend of a market, I'll use the last 10 minutes because we're ending in 10 minutes. Identifying the trend of a market. You could use this indicates the moving averages that I showed you guys last time, which is the MA21 and the EMA8. It shows you if a market is in an uptrend or downtrend or consolidating. Or we also have what is called trend lines. I barely use trend lines, honestly, but you know, this trend lines as well. You use them to know to identify the market. And there could be major and minor trend lines depending on what time frame. You know, there could be you could literally have a 4-hour trend line and also have a 1-hour trend line. You can have a trend line within a trend line, all that type of stuff. You know, so when you have like a whole market moving like a whole uptrend like that, you could literally just draw a trend line from one low to like this to like that. That's identifying the trend. That's that the trend is on an uptrend. And the moment the trend line is broken like this, break and retest of the trend line, you could trade that as well. Sometimes you see scenarios where the market breaks the trend line and there's a certain level of support on the same level where the market breaks that trend line. So it's like, okay, the market did a break and retest on the support and it tends to resistance, and it's also aligned with the trend line, and it's also breaking structure, all of that. So those type of confirmations, you start understanding them that, okay, this is A, B, and C together, so I know that the market's about to sell. You know, some days you see only A and B, and it'll still give you D. To do you might see A, B, and C, and it'll give you D. You know, just how like trading goes. You see this and this, it will give you the same scenario. You see this and this, to give you the same scenario, just like that. Some days there might be more confirmation than others. Some days you might have all the confirmations you need to see in your world, and it'll still be an L trade. You'd be like that, just the world we live in. So like that's just like trend lines. You can have an for the downtrend as well. The same thing. You just put the trend line at the top, just like that. Enjoy your trend line from year to year. So for me personally, right, what matters most for my trend line is my point A and my point B. Those are the two places that matter the most when I'm drawing my trend line, point A and point B. Like everything else really doesn't matter. Like if I take this point A is where I'm starting my trend line. If I'm choosing this place to be my point B, I'm drawing my point B like this. Like if you say all of these other things are like a little bit out of it, that's it. But you don't want to choose your point B to be somewhere that price is moving out of your trend line. You want your point B to be where price would be under that trend line. So you know that, okay, when you have your trend line like this, everything under this trend line is a seller's market and everything above this trend line is a buyer's market, and vice versa right here. So that's a way of identifying a trend using either moving averages or using a trend line. So let's go on the chart right now and let's see how we can look. Sometimes you could use your line chart to identify structure rather than using the candlesticks if you're unable to see it. And the higher time, the more on the higher time frame you go, the better, because that's where you can literally like see structure easily. If you don't have to use the 1 hour yet, you could scale on the 4 hour and stuff. But structure in the market will always be broken back and forth. It will never just like, not that it will never, but it won't always be the cleanest. Like let's look at the year. Market is in an uptrend, right? It creates a higher high, higher low, 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 lower high, lower low, right? Lower high equal low, higher high equal low still, because all of these are the same. Then it comes and give you lower high, because this high is lower than this previous high. Comes again, then break down structure and gives you, this is the lower low, little lower high, lower low, lower high, lower low, lower high. Why is it not clicking? Higher low, higher high, higher low, equal highs, lower low, lower high, So this is how you need to get on the chart and be able to identify all of these things and see which one is coming after which. Like you've seen how I'm identifying all these things. The market is switching structure back and forth. It's not just moving smoothly. Like you're seeing break of structure, you're seeing the market entry from retracement phase to reversal phase to expansion phase, all of that type of stuff happening right now in the market. Right here, we've seen the market is expanding, it retraces, it expands, it retraces, it's okay, it's about to expand, but that expansion phase does not happen because we know that after a higher low, it's a higher high, right? But the market gave us a lower low instead. I mean a lower high. So if the market gives you a lower high, that means that now these buys will no longer be an expansion, but now these buys were their retracement, and this market has switched structure. So now the sells is the new expansion. It expands down to the downside, it retraces, and it's about to expand again. But what happens? Price finds a level of support that is not able to break. This price level here, a level of support that is not able to break. And then what happens to it? It respects it and pushes up and breaks all these previous highs, creating a new higher high. After a higher high is a higher low. It gives you a higher low, right? You're expecting another higher high. It pushes up, but fails to break this high. If it fails to break this high, that means it's giving you a lower high. So meaning the next thing you're expecting is a lower low. Price now push down, give you a lower low, which now this is a new expansion phase and no longer a retracement phase. And then gives you another lower low, a miniature lower high, pushes down again, just like that. So that's why you want to be on the side of expansion, because when you look at these retracements, if you try to enter into a buy for these type of things, you see how you easily get clapped, So always being on the side of structure, on the side of the flow of structure is the best things. If it's selling, you just want to keep selling. If it's buying, it's better to keep buying rather than trying to buy in the seller's market. Like right now for you guys, the best thing is to buy when it's buying and sell when it's selling. Don't try to counter trend. I won't say I don't think you guys have that experience yet to be able to counter trend. So all of these I've taught you guys today. Go on your charts, go try to identify the expansion phases, the retracement phases. Go try to identify the higher highs and higher lows, identify the break of structure, identify the retracement phase, the reversal phase, all of those things. Like everything we've learned today is a major thing. Where next time we'll go over our candlestick patterns. Next class will be on candlestick patterns and probably a little bit of entries and exits. Then after that, we'll talk about probably a little bit about trading plans. So you guys can start knowing how to make your trading plan, so you can start opening up those demo accounts and you can know why you want to buy or why you want to sell in the trade. So all of these things, we're going to finish it really fast. Like trading is not that difficult. As long as you're showing up to the classes, you're watching the videos, you're practicing probably 1 to 2 hours a day, you're going to be good. You're going to be Gucci. You don't have nothing to worry about. So that is the end of today's call. Before I end the call, is there anything or any question that anybody has so far? All right, Cloud, you're welcome. All right, since there's no questions today, I want to thank you guys for showing up to the call. I want you guys to keep taking this seriously because this is your road to freedom. You know, this is a big financial freedom right here. So you guys take it seriously. You all stay blessed. I'm gonna see you guys on the next one.